Hello guys, welcome to my channel. I'll do a quick portfolio update. After that, I'll share how I select stocks for the long term, and I'll use the Meta stock as an example. I think this process doesn't guarantee any quick profits, but it has definitely helped me to avoid permanent capital losses by uncovering a company's real performance, which is usually hidden behind the stock prices. As you can see, the portfolio value has gone up a lot, and about half of it is due to the market rally happened last week. I have also contributed close to $7,000 to add to my existing Scotiabank and Google positions. You can find my past purchases in my YouTube short videos. As you can see, my portfolio has been lagging behind the SP 500 this year due to large exposure in the tech sector and especially the Meta stock crash. But I think it should outperform in the long run. Please note that I cannot guarantee an outperformance, and if that happens, I will try to find out the reason, and I think that will be a valuable lesson to learn. Now onto the stock analysis process. I'm usually looking for the following from a company behind the stock. My apologies for putting so much text on one page, but I think this is the minimum you need to know to not get crashed in the market. Please note that this is just a very generic template and mainly work for large, profitable, and asset-light companies that don't rely on the economy of scale as their competitive advantages. This has been working well for me to select profitable technology companies. There are two things to note for the PE ratio requirements. The first is that it is okay to pay a bit more for higher growth, but I personally won't pay more than 30. The second thing is to make sure that the PE ratio is not jumping up and down in recent years to make sure that there are no one-time earnings or losses that are skewing the data. Now let's use the template to take a look at the Meta stock that has crashed about 70% this year. On first sight, we can see that the company has a market cap of 300 billion and a PE ratio of only 10. That satisfies our company size and PE ratio requirements. A PE ratio of 10 suggests a nice 10% return for shareholders on current earnings and has potential to increase in the future as well. And now we just need to look at the PE ratio of the recent year to check if there anything special happens. Here we're on the stock unlock tool. Under the freeform tab, we can plot the historical PE ratio of the company. As you can see, the ratio has been going down consistently, which is a good thing because this indicates the company is selling for cheaper price relative to its profitability. This makes the company passing the second requirement of our template. Now let's take a look at the company's competitive advantage by plotting the revenue and net income for the past 10 years. We can see that the revenue and earnings has increased consistently by 40% annually in most of the past 10 years, except the declines happen in recent quarters. I think it is normal for a company to face some headwinds once in a while, and if they have the advantage, they will get over it sooner or later. Now let's also take a look at the net profit margin. We can see that the company has an average margin of 33%, and it stays above 20% after the recent headwind, above our 15% requirement. So I don't see any problems here, and the company passes the third requirement. The next data to check is the return on invested capital, or ROIC, of the company. This number is again really good, at more than 20% right now, with an average of 15% in the past 10 years. This indicates the company have invested the shareholders' capital pretty effectively, but since the recent ROIC number has been decreasing due to some unprofitable new investments, we need to monitor the company closely to see if the new projects they're developing make sense. Now, I think this becomes a personal question for the investors, whether they like the new projects or not, to decide if they want to keep investing in the company. In Meta's case, the new projects will be the metaverse and the better AI algorithms for their social media apps. Next, we need to check the fifth requirement, which is the company's financial position. First, let's look at the current asset and current liability of the company. I have plotted both of the data on the chart, and we can see that the current asset is much more than the current liability of the year, so they can easily afford their short-term debt. Another thing we need to check is the interest coverage for the long-term debt. To do that, I need to plot the net income and the interest expense. Okay, so now we can see that the net income for the current year is like 100 times more than the interest paid on the long-term debt. So the company is in an extremely strong financial position. The company can just keep using their own income for future investment and will be able to raise that capital easily if they need to. The last important aspect to look at is whether the company is shareholder friendly. First, we need to look at if the shares outstanding are decreasing. This will give us shareholders more ownership in the company. And from the chart, we can see that even though the company has diluted in the past, they have started buying back shares starting from 2017, which looks pretty good. And next, we need to take a look at the insider ownership. Here, we're in the Simply Wall Street website, and if we search for Meta stock and going to the ownership tab, we can see that even though there's some insider sellings, the CEO Zuckerberg still owns significant shares in the company with the 38 billion stake. The two co-founders, Eduardo and Dustin, also keeps their shares, and this tells me that insiders are still bullish on the company, which is a very good sign. That's all for the quantitative analysis. So far from the numbers, the company looks great, but there's another important check is to make sure that you can understand the business enough to be able to hold it for a long term. I think this check can effectively reduce my fear when the stock price drop. I personally have to use Meta's product like Messenger and WhatsApp to talk with my friends and family because that's the only place I can reach them. I also text them, but people change their numbers all the time, so it is always safer to reach out on Facebook's apps. There should be many people in the same situation like me, and this network effect can give Meta a great competitive advantage so long as the number of active users stays consistent or growing on the Meta's apps. Another driver for future growth is WhatsApp. It's a platform that is used by 20 billion people worldwide, but Meta has not started monetize it yet. But I think that will change very soon. And that's all the reason why I'm continue holding the Meta stock. There are still risks because they're losing a lot of money on the metaverse part of their business, but I think I can just ignore it for now since the other part of the business is still going strong. And that's it for today. See you next time.